Welcome to TalkTickers. You're tuning in for a deep dive into the first quarter 2025 earnings call for RenaissanceRe Holdings Ltd. Think of this as your shortcut to the essential insights, what really moved the needle, and what management is signaling for the future. Let's get right to it.
Yeah, thanks. It was, definitely a complex quarter for them. RenaissanceRe reported an underwriting loss of $771 million.
Wow. Okay.
Yeah, driven by some pretty significant catastrophe events. That led to a modest operating loss overall for Q1.
Right.
We also saw fee income take a pretty big hit. It was down 64% compared to last year, landing at $30 million. And that actually included negative performance fees of $16 million.
Ugh, negative fees.
Exactly. And looking ahead, they've also bumped up their guidance for the combined ratio in their casualty and specialty business. It's now expected in the high 90s, up from mid to high 90s before.
Okay, so a tough quarter on the underwriting side seems largely driven by those big cat events. Can we break down the impact of those losses? Where did they hit hardest?
Absolutely. So the net negative impact from these large losses came in at $703 million after tax.
$703 million.
And the vast majority of that, $633 million, was from the California wildfires.
Right. That makes sense. That was huge.
It really was. And it had a substantial impact, as you'd expect. Pushed the overall GAAP combined ratio to 128%. Just the large losses alone contributed 52.6 percentage points to that.
Wow.
Yeah. Drilling down a bit, the property catastrophe segment, its combined ratio was 176%.
Whoa.
But it's worth noting their other property business actually managed a profitable quarter, came in at 84%. And casualty and specialty was 111%.
Okay, so some diversification benefits there, maybe.
Seems like it. And importantly, despite all these underwriting headwinds, they still generated $279 million in retained net investment income. That got a nice boost from $328 million in mark-to-market gains.
So the investment side provided a bit of a cushion then. What about how they managed their capital during this period? Any big moves?
They were definitely active. They bought back 1.5 million of their own shares.
Yeah.
Spent $361 million on that, an average price of about $242 per share. And they also went to the market and raised $800 million in debt.
Right.
And here's the interesting part. Despite those losses we talked about, their annualized return on average common equity was still 7%.
7%, even with those cat losses.
Yep. And a key metric, they always highlight tangible book value per share plus accumulated dividends that actually increased quarter over quarter.
Huh. Interesting. So even with those significant underwriting hits, they managed to keep some key indicators moving, in the right direction. Let's pivot to what the leadership team was saying. The CEO gave his take on the bigger economic picture, right?
Yes, he did. He really framed the current macro situation as one of pretty unprecedented uncertainty. Lots of questioning of the sort of established post-war economic norms.
Yeah, seems fair.
But what's really interesting is how he positioned RenaissanceRe in all this. He basically argued their business is anti-correlated to this environment.
Anti-correlated, meaning?
Yeah, meaning that the increased volatility we're seeing, that actually creates more opportunities for them. The core idea is, more volatility often equals greater demand for risk transfer, which is exactly what they sell.
Okay, that makes sense.
So he anticipates things like, say, tariffs or even a potential recession will have a pretty limited direct impact on their main business lines. Property cat, traditional casualty, most of their specialty lines.
Anti-correlated, but that's a pretty bold claim. Can you dig into why he sees it that way?
Especially thinking about a potential recession.
Sure. He specifically called out the property catastrophe business as being highly recession resistant.
Okay.
The logic is pretty straightforward. The fundamental need for insurance against major natural disasters, that doesn't really go away just because the economy slows down, right?
Right. People still need to insure their homes and businesses against hurricanes or earthquakes.
Exactly. He also mentioned that potential inflation, the risk that rebuilding costs go up after an event, that's already something they factor into their property risk models.
Now, he did acknowledge some niche specialty lines, like maybe trade credit or political risk, might see some indirect impacts from economic shifts. But he stressed those lines usually have built-in protections. And historically, he pointed out, reinsurance premiums haven't really suffered much during past recessions.
That makes sense. Core insurance needs persist. What about their investment strategy then, given this uncertain outlook he painted?
Well, right now the approach is pretty conservative, a strong emphasis on high-quality fixed income.
Okay.
But they haven't just been sitting still. They actually use some of the recent market dislocations, the volatility, to strategically increase their allocations to equities and also to high-yield investments.
So taking some calculated risks there.
A bit opportunistic, yeah. And furthermore, their hedges, things they put in place against inflation and geopolitical risks like holding long gold futures, those really paid off and helped drive those strong mark-to-market gains we saw in Q1.
So a sort of defensive core with some tactical offensive moves. Okay, let's zoom back in on Q1 performance specifics. Sounds like those big events really defined the quarter.
They certainly loomed large, yeah. Despite those hits from the California wildfires and also the American Airlines tragedy, management characterized the underlying performance as pretty solid.
Okay.
So while, yes, there was that modest operating loss, the diversified business model plus those strong investment gains we just talked about meant they actually booked a net profit under GAAP accounting.
Right, that GAAP profit, despite the operating loss.
Exactly. And like we mentioned earlier, that key metric, tangible book value per share plus accumulated dividends, it still ticked up during the quarter.
They also made a point, I think, of comparing this quarter to previous periods with big losses. What was the takeaway there?
Yeah, they did. They drew parallels to other major loss years like 2005, 2017, 2022.
Okay.
And the trend they wanted to highlight was that over time, catastrophe events of similar size are having a progressively smaller impact on their combined ratio.
So they're getting more resilient.
That's the argument. And at the same time, their operating returns on equity have actually increased over those periods. Management presented this as, clear proof of the growing strength of their model, driven by those three profit engines working together.
Right.
Underwriting, fee income, and investments.
And the timing of these wildfires happening early in the year, did that cause any major shifts in their strategy for the rest of 2025?
According to the CEO, no. He basically said, look, the timing of these big events is inherently unpredictable. It doesn't fundamentally change their full-year plan, which is still focused squarely on writing profitable business.
Makes sense.
He really emphasized that right now, preserving strong underwriting margins is the best way for them to grow that tangible book value per share metric.
Yeah.
And they kept buying back shares too.
Right, you mentioned the buybacks?
Yeah, they view the recent market dips as a good opportunity to repurchase stock at attractive prices, which again, kind of ties back to that whole anti-correlated idea.
Got it. Okay, the CFO then gave the more detailed financial breakdown. What were the main points from his review?
Well, he reinforced that 7% annualized ROE figure, emphasizing it was achieved despite the big losses.
Mm-hmm.
And he highlighted how the three profit drivers responded differently. You had the underwriting loss, the suppressed fees, but then the really strong net investment income.
Right, the three levers.
Exactly. He noted that back in 2024, retained net investment income added a hefty 12 percentage points to their ROE, and they expect a similar contribution level again in 2025.
Okay, so investments are a key part of the story.
Definitely. He also touched on Bermuda's new 15% corporate income tax.
Yeah.
It's now in effect. But interestingly, they actually reported an income tax benefit this quarter.
A benefit. Yeah.
It was due to releasing a deferred tax asset they had on the books. So kind of a one-off accounting item there.
Okay. Let's circle back quickly to the breakdown of those large losses across the different business segments.
Sure. So total after-tax impact, $703 million. Wildfires, $633 million of that. Now, an interesting side effect was that these huge wildfire losses triggered a big jump in reinstatement premiums in their property catastrophe segment.
Explain reinstatement premiums quickly.
Yeah, basically after a big loss eats into the coverage limit, the client pays an extra premium to restore that limit back to its full amount for the rest of the policy period.
Got it.
So this surge in reinstatement premiums meant their gross and net premiums written in property cat shot up quite a bit, which also helps explain that really high combined ratio of 176% for this segment. A massive 159 percentage points of that ratio was directly from the large losses.
Okay, makes sense.
But like we said, other property was so profitable, 84% combined ratio, and they expect the underlying sort of normal attritional loss ratio there to be in the mid-50s going forward.
And what about casualty and specialty? How did that segment hold up?
Premiums written there were down just modestly. The combined ratio was 111%. Now, that included impacts from several large events, not just the wildfires, but also the airline tragedy, some refinery fires, plus some premium adjustments.
Okay.
Looking ahead, that's the segment where they raised the combined ratio guidance to the high 90s. They specifically mentioned the potential for cat-like volatility in this book. meaning, big unexpected specialty losses can happen.
Right, not just property cat risk.
Exactly. And their fee income, which mostly comes from managing capital for others, like in their DaVinci vehicle, that was down sharply. Lower management fees, those negative performance fees we mentioned, though they do expect that to improve in Q2 and Q3.
Okay. The investment portfolio really seems like the bright spot this quarter then.
It really was. Generated strong retained returns and those significant mark-to-market gains. That came from a few things working together. Lower treasury yields helped bond values, and their hedging strategies were effective.
Like the gold hedges.
Yeah, partly that. They also proactively worked to make the portfolio more resilient to inflation, managing the yield curve exposure, increasing commodity positions like gold. And, as we touched on, they used the market volatility to add some exposure to global equities and credit.
So, quite actively managed.
It seems so. The portfolio's retained yield maturity is sitting at 5.1%. Average duration is 3.1 years. They're expecting retained net investment income to be roughly flat in Q2 compared to Q1.
Okay.
The CFO also made sure to mention they kept buying back shares even after Q1 ended. And he noted that successful $800 million debt raise happened at very tight, favorable spreads.
Good execution there.
And one last point from him. The operating expense ratio actually went down. That was mainly due to lower performance-based pay, given the results, and also the effect of those reinstatement premiums boosting the denominator. They expect a more normal expense run rate just above 5% going forward as they continue to invest in the business.
Got it. Okay, let's move to the Chief Underwriting Officer. He offered insights into their operations and the market dynamics, right?
Yes, the CUO. He really emphasized their core strengths: deep underwriting expertise, a partnership approach with clients, and strong internal coordination. He said those are key differentiators, especially when the market gets choppy like this.
Makes sense.
Their immediate focus after the wildfires, he said, was just supporting clients, helping assess losses, paying claims quickly. He also highlighted the January 1st renewals as successful. They actually increased their property catastrophe capacity.
Oh, interesting. Even before the Q1 losses.
Well, the renewals were Jan 1st, so yes. They increased prop cat, maintained strong positions in specialty and credit, but continued pulling back a bit on casualty lines, which they'd signaled previously. And again, he stressed the benefit of that diversified underwriting portfolio feeding the three profit drivers.
Okay. What's his view on the market now as we head towards the mid-year renewals, especially in property?
He sees conditions looking more favorable for reinsurers now compared to Jan 1. A better balance, he thinks, between supply and demand for reinsurance capital.
And specifically in Florida, that's a big renewal season.
Exactly. He highlighted Florida, specifically seeing growing demand there and strong pricing. So RenaissanceRe actually plans to deploy additional catastrophe limit in Florida, focusing hard on getting good margins.
Okay. What about other regions?
Japan renewals, he said, were pretty orderly. They held their share, even though rates dipped a bit. Other property, though, that's facing more competition, some rate pressure. So there, they plan to use ceded reinsurance, buying reinsurance for themselves to help manage the portfolio and keep it attractive.
Gotcha. Did he talk about the possibility of recovering any of those California wildfire losses?
He did mention it. There are potential avenues, like subrogation for the Eaton wildfire.
Meaning going after a third party if they were responsible.
Exactly. And also potentially recouping some assessments from the California Fair Plan. And this is but he cautioned that these are just potential recoveries. They aren't baked into the current loss estimates yet. It's too early.
Right. Don't count your chickens.
Pretty much. On the casualty and specialty side, he noted the combined ratio there was hit by several large kind of one-off specialty losses, distinct from the broader casualty liability trends they've been managing. He did say the aviation and marine and energy markets within specialty are generally doing well.
And his perspective on those broader casualty trends, is the market turning?
He sees encouraging signs, was his phrase.
Yeah.
Clients are still pushing rate increases, and he sees more sophisticated claims management strategies being implemented. He described it as a sort of two-stage response in general liability. First, insurers cut limits and hiked rates, and now the focus is shifting more towards better claims handling.
Okay, so progress, but maybe slow.
That seems to be the view. He pointed out that while rate increases since 2019 have been significant in cumulative terms, loss trends have also been cumulative. So they're staying cautious, still reducing exposure in some areas, and they're not yet fully recognizing all those rate increases in their loss picks until the data really confirms improvement. It's a long game for them in casualty, he mentioned, thinking in terms of a 10-year time frame.
10 years. Okay, that's perspective.
Yeah. Professional liability, he noted, is seeing primary insurers pull back capacity, so they remain cautious there too. But overall, the specialty lines, especially with the Validus acquisition integrated, still look largely attractive. And the credit book, being watched very closely given the global economy, positioned prudently for a potential recession.
That mid-year renewal commentary definitely sounded relatively positive for reinsurers, at least in property cat.
Yeah, the focus is definitely on rate adequacy there, which they feel is in exceptional shape. Casualty has those green shoots, improving rates, better claims management. Specialty remains generally well rated. And yes, the overall trading conditions for mid-year look better for reinsurers than back at Jan 1. More renewals coming up that have actually experienced recent losses, which tends to support pricing.
And Florida seems key.
Very key. Growing demand, strong pricing, partly driven by Citizens, the state insurer, shedding policies, and the Florida Hurricane Cat Fund's attachment point moving up. Other property areas are tougher on rate, so that's where they plan to deploy more of their own cat capacity selectively. General liability. Good track, but improvement takes time.
Let's clarify that increase in the casualty combined ratio guidance. Investors will zoom in on that. What was the precise reason again?
Right, the hike to the high 90s for casualty and specialty combined ratio guidance, it was explicitly attributed to those handful of large individual specialty losses in Q1. The wildfires hitting some specialty lines, the airline tragedy, the refinery fires, plus some premium adjustments and non-recurring items affecting acquisition costs.
So not a worsening of underlying casualty trends.
Management was clear on that. They said the underlying casualty trends and loss ratios are stable. The guidance increase reflects the volatility that can pop up in that specialty book, rather than a change in their view on core casualty.
Okay, that's an important distinction. What about their third-party capital platform, DaVinci? Any major shifts there post-Validus?
The allocation of cat risk to DaVinci has stayed pretty stable since the Validus deal closed. No major changes reported there.
And reserves. Any surprises, positive or negative, in Q1?
They actually had some favorable reserve development. It came primarily from the proportional side of their other property book. This emerged from their regular annual review process and covered a mix of risks.
And on the casualty side, still confident.
They expressed confidence, yeah. Pointing to their underwriting discipline and robust processes for tracking loss trends, they feel the diversified C&S portfolio is performing well overall, and they continue to be conservative about recognizing the benefit of recent casualty rate increases in their reserves.
Okay. And their overall take on market conditions now? Are the big 2023 rate hikes sustainable?
Their view is that 2023 wasn't just a reaction to losses. It was a fundamental reset caused by years of, frankly, unsustainable underwriting results, low retentions by primary insurers, overly broad terms.
So a structural shift, not just cyclical.
That's how they see it. They view the current market as much more stable, more historically normal, actually. So their expectation is that these higher rate levels will generally stick. You might see some trading up or down on individual deals, but they don't expect a broad slide back to pre-2023 pricing.
Makes sense. And capital allocation priorities now? Growth versus buybacks?
They feel they're in a strong enough position to do both. Right now, pursue growth and continue repurchasing shares. The big focus is on preserving margin in this environment. Growth opportunities are seen mainly at the higher layers of property catastrophe programs.
What about that gold exposure? Is that a permanent shift?
They described it as more of a tactical move, a hedge against the high economic uncertainty, potential unknowable shocks, not a fundamental change in their long-term investment strategy.
Got it. How do those loss-impacted renewals at mid-year play out? Do clients shy away?
Well, loss history definitely matters deal by deal. But often, clients who've had losses are actually quite loyal to the reinsurers who paid their claims. RenRe specifically mentioned they've updated their wildfire models after these recent events, so they feel confident quoting on deals affected by those fires.
And the Florida market reforms, are they seeing tangible benefits yet?
They said the reforms are having a positive impact on claims trends in Florida, but stressed it's still early days. The effect is maybe more visible right now on attritional loss ratios and the profitability of domestic Florida insurers rather than directly on catastrophe losses yet. But that positive trend is factored into their overall view that the Florida market remains attractive.
Quick points. Tax rate, what should we model?
They suggested modeling something slightly above 15% is probably appropriate just to account for income they earn in places with higher tax rates than Bermuda.
ILS competition, especially non-cat bond ILS.
They don't see it materially impacting their competitive position right now. If anything, potential headwinds for allocating new capital to alternatives might affect the broader ILS market. They expect their own third-party capital footprint to be stable, maybe even grow slightly.
Timing on those potential wildfire recoveries, subrogation, fair plan.
Highly uncertain. Depends on regulatory processes in California. Investigations. They haven't even confirmed the ignition source for the Eaton fire yet. Way too early to put a number or timeline on any financial benefit.
Okay. Given the Q1 hit, what's their outlook for full-year ROE, assuming normal cat activity going forward?
They express confidence they can still deliver a solid full-year ROE under an average cat load for the rest of the year. The portfolio, they stressed, is built to generate healthy returns on an expected basis.
Growth appetite at the June 1st Florida renewals.
They see the market growing, significant new demand for cat cover, mostly at the top end of programs. RenRe has capital allocated for potential growth, but they'll be selective, making deal-by-deal decisions, always balancing profitability with capital efficiency. Focus is on building a resilient portfolio for the long haul.
Any constraints on firepower for growth or buybacks?
They stated clearly, no constraints from a liquidity or capital perspective. Their capital position is strong, reflecting good earnings and the performance of all three profit drivers over time.
Last one. Mortgage business saw higher premiums. Change in strategy.
No, that was just timing of premium adjustments, apparently, not a strategic shift. The long-term trend, they reiterated, has been to actually reduce mortgage exposure and make the portfolio more resilient to a potential recession.
So quite a quarter. Significant cat losses, yes, but also clear signs of resilience from their diversified model and investment side. And management sounds, well, cautiously optimistic, especially about property cat pricing holding up.
That sums it up pretty well, I think. They definitely weathered a storm in Q1, but came out emphasizing the underlying business strength and what they see as improving dynamics in key markets.
All right, let's transition now. It's time for our This Is Not Financial Advice segment. This is where we put on our speculative thinking caps and kick around a potentially interesting, maybe even outrageous, but perhaps plausible trade idea based on everything we've just heard.
Okay, let's brainstorm. So given RenRe's pretty positive commentary on the Florida property cat market, increased demand, strong pricing, maybe helped by citizens shedding policies, and the cat fund changes.
Right. They seem quite bullish on Florida specifically.
Yeah. So one could maybe consider, and again, pure speculation here, a long position in some select well-capitalized primary insurers that are heavily focused on Florida, but are also demonstrably improving their expense ratios and have solid reinsurance programs, perhaps heavily featuring partners like RenRe.
Okay, so betting on those Florida specialists, benefiting from the improved market and RenRe's support.
Kind of. The bet hinges on loss trends continuing to moderate there, thanks partly to the reforms, and these insurers capitalizing on the market dynamics while maybe getting good terms from reinsurers like RenRe who are looking to deploy more capital there. It's definitely risky. Hinges on a lot going right in Florida.
High risk, high potential reward, maybe. What about a hedge?
Right. To maybe offset some risk, you could consider a small balancing short position, perhaps against national carriers that have significant exposure to, say, wildfire-prone areas outside of California, where maybe the modeling and risk assessment aren't quite as developed yet.
Interesting. Hedging against potential surprises in less understood geography.
Exactly. Just an idea to hedge against unforeseen large losses elsewhere. But look, this is purely a thought experiment. Highly speculative, absolutely not investment advice. You absolutely must do your own thorough research before ever considering any investment.
Couldn't agree more. Okay, that wraps up our deep dive into the RenaissanceRe Q1 2025 earnings call. We've hit the key results, unpacked management's thinking on a, well, very eventful quarter. We hope this gave you some valuable insights, a quicker way to get up to speed. What stood out most to you as you listened? What questions do you still have? Definitely keep digging with your own research. Thanks for tuning in to TalkTickers.